Hello, Patrick Walchuk here, and it is the beginning of 2026, and what we're doing is we've gone back to last month, December 2025, selected a building that's sold, a multi-unit building, and we break down the financials for you as we do every month and interpret what those financials mean to give you an idea of buildings, their cap rates, their operating expense ratios, that kind of stuff. So let's get right into it, and we're going to look at a triplex that's sold in Central Ottawa, and I believe I had shown this property at least once back in the summer, and when it was last listed before it sold, it was listed at $849. It sold for $815. Not surprising. I'd say the property needed a lot of work. Not just maintenance, but capital cost expenditures were required on this property. It had a scheduled rental income of almost $80,000. The effective rental income was about $77,000. The operating expenses on it were $15,000. And when you factor in maintenance and management, as a bank appraisal methodology would do, that gives us a total operating expense number of almost $23,000. So we can then calculate what our net operating income is, and that's $54,500, let's call it. So what does all that mean? Well, it means a very, very high capitalization rate of almost 6.7%, which is sort of off the chart. And it doesn't really surprise me based upon the condition of the property. The operating expenses on it, surprisingly, were very low at 29%. Anyhow, this is really quite low, sold for 11 times the gross and 15 times the net, and that's not unexpected when you see a very, very high cap rate. Now, you, according to CMHC, need a minimum down payment of 20% when you buy a multi-unit property, so that's the reason why we're using 20%, but we usually just look at a number to determine what percent down payment's required for this property to break even, basically, right? Anyhow, we stuck with 20% here, just because that's a minimum requirement, and we use a mortgage rate of 4%, and that gives us a monthly mortgage of about $3,430. Now, the annual debt service on that mortgage is $41,000 and change, and with this 20% down payment, that gives us a positive cash flow of $13,000, or an ROI on your money of 8%. Now, you spend $163,000 and get 8% back. If you're in the equities market or something, that's pretty darn good. But you have to understand the total picture, and this doesn't display the total picture, but it does give you a reason why this happened, and you're looking at, well, gosh, that property must have needed a lot of work. And this kind of points that out. So anyhow, thank you for watching.